Hi, this is just a summary of all the calculations in IB Business. So get on with it. These are the gross profit is equal to sales revenue minus cost of goods sold. This is like the most simple one. So sales revenue is just the money you make from selling these things. Like I say, you have toys, just you sell like 3 of them for $5, you end up with $15. That's sales revenue. It's raw, it's simple. Cost of goods sold is also raw and simple. It's just like the raw materials, the cost of the plastic to make it, nothing more than that. Just the cost of the things solely to make that product, and that's gross profit. Then you have normal profit, which is your gross profit, but minus your expenses. So expenses are things like rent, electricity. These are fixed costs. And they're just the things that the business will always have just to stay afloat and keep running. Okay. Then we have our depreciation formulas. These are not in the formula booklet, so they need to be memorized. Annual depreciation is equal to the purchase cost. And there's something to add here that I'll talk about in a second. Over the lifespan, usually in years. If it would be months, that would be monthly depreciation, right? Okay. It's quite unusual for you to buy something and then for it not to have scrap value, right? Even just a tiny bit, even just the materials, if you were to melt whatever you bought, would have some residual value, which is why it's purchase cost minus scrap value. Scrap value is also called residual value, by the way. Okay, that's your annual depreciation. So, purchase cost is $15. Scrap value is $5 over lifespan of years. So say it lasts 2 years. So then your annual depreciation is $5 a year. Okay. Then the next depreciation you have is depreciation per unit. This one seems a bit more common in questions for some reason, I guess because it's less straightforward. They ask it in HL exams more. Is purchase cost minus scrap value, so the top is the same, over expected number of units. Now units can be units in the context of the object you're looking at. So if it's a photocopier, units is probably amount of pieces of paper photocopied. If it's a machine that mills wheat or something like that, maybe it's hours running. Okay, so we can do an example here that if our purchase cost is $50, we get $10 of scrap off it, and I'm expecting 20 units. Okay, this is a machine that makes toys. Okay, so 20 toys. Units is toys in this context. And my depreciation per unit is 40 over 20, which is 2. So in the context, that means that every toy my machine pumps out, the value of that machine drops by $2. So then the next formula is kind of straightforward, but it's depreciation expense. So depreciation expense is the depreciation per unit, which we just found to be 2. I'll just write that as DPU times number of units. Okay, so if the question asks, what is the depreciation once my machine has produced 10 units? So that would be 2 times 10, so it's dropped by $20. So after my machine has pumped out 10, what was it? Okay, I already forgot. But after it pumps out 10 units, it's dropped by $20. Okay, after it's pumped out 20 units, it's dropped by $40. Okay, that's pretty chill. That just needs to be memorized. Okay, the next ones are margins. So we have gross profit margin margin is equal to gross profit as the sales revenue. Now, if you recognize this formula, it's showing a percentage, okay? So it's a percentage of the sales revenue that is gross profit. So say my sales revenue is $100 and I make 90 in gross profit. I'm looking at 90% of a gross profit margin, which that's really good. That's saying 90% of all the revenue I get is profit. So if you had 100%, that means all of your revenue is profit. So I don't know what you're selling, but that's probably not possible, right? But if it's 80, then 80%. If this was 80, then 80%. So usually 60, 70, that would be really good. Okay. The next one is profit margin, which is the exact same formula. But if we remember our differences between profit and gross profit, we're kind of taking that expenses into that profit. So it's just profit over sales revenue. And we should still remember that this does not have interest and tax in it. That's because interest and tax numbers, they change all the time and fluctuate from year to year. So if we were to make comparisons of a business's profit margin, either between countries where tax rates can fluctuate or between, time frames, this kind of makes the comparisons invalid if we were to include interest and tax because they change all the time. So in order to have valid comparisons across countries and timelines, we keep interest and tax out of these margins. Oh yeah, and that's still a percent as well. I forgot to add the times 100. Okay, next, this is a really important one. It's often called the key one because every business really wants to look at this, and it's return on capital employed is equal to profit, again before interest and tax, because we want those comparisons to be clean of fluctuations, and tax over capital employed times 100. Okay, what we're looking at here is what your return is for how much you actually put in. So let's imagine our profit was $100, but we employed $200. So 100 over 200, is that 0.5? Yeah, 0.5 times 100, we're looking at, my days, that's 50%, right? Yeah, 50%. Okay, so that's saying for every $200 we put in, we get 100 back. So we get 50% of what we're putting in back, which is pretty good, right? But we also need to remember that we need to look at context of the of this value. So compare it to industry averages or compare it to previous performances. So even if the return on capital employed is 60%, it could have been 70% last year. So you need to think about the context of it's dropping and comparing it to other competitors in that industry as well. So yeah, this is just saying, for every $200 an investor puts in, they're going to get 100 back. So investors will always look at this value because it shows you how much you get back. Another really, really important thing to note is this percentage value should always exceed the interest rate of just chucking that money into a bank. Because imagine you got this as 4%, but banks said, we'll give 6% interest. Why on earth would you just not put the money in the bank and get 6%, and that's also safer, and you're also guaranteed that 6%. So the return on capital employed should always exceed what just chucking the money in a bank would to actually make that investment or that project attractive in the first place. Okay. Oh yeah, and also this confused me a lot at the start. I'll just get rid of this, clean it up a bit. But capital employed is equal to non-current liabilities plus equity. So equity is share capital and retained profit. So that's like the physical cash the business is holding on to and it's got. Non-current liabilities are things like long-term loans. So this is what the business can actually use. They can use money from long-term loans, and they can use money they have to start to generate profit. So capital employed is what a business uses to generate profit, and return on capital employed is how much that profit actually is as a percentage of the money they used to generate it, right? Okay, the next thing are these ratios, liquidity ratios. Okay, we've got current ratio. This is equal to current assets over current liabilities. Okay, current assets are things that they will sell in the next 12 months, and current liabilities are the same, liabilities that need to be given off in the next 12 months. So essentially, what we look at here is the business's ability to cover current assets, current liabilities with a current asset. So say their current assets is $10 and their current liabilities is $5, you'd get a current ratio of 2, which means for every dollar of current liabilities, they have $2 of current assets. Now that's pretty good, right? You always want it to be around 2 or 3, a bit higher than 1.5 at best. Because you want to show that a business can cover its current liabilities with its current assets. So its current assets should exceed its current liabilities. Okay. So then next we have acid test. Well, this is AKA the quick ratio. Which is equal to the exact same thing that we just looked at in current ratio. Current assets minus stock over current liabilities. Okay, the only difference we're actually going to notice here is that minus stock. Now the reason we have that difference is because stock cannot always just be quickly sold off, right? Sometimes it's unfinished products which don't have much added value. Sometimes it's things that are really, really expensive, which you just can't sell quickly, right? So acid test ratio gives a bit of a better indicator on this kind of current ratio, on how much current assets the business has to take off its current liabilities without stock, because stock cannot stock. Right, stock turnover is also pretty chill, is equal to the cost of sales over the average stock. Okay, so if the cost of sales was, for example, $100,000 and the average stock was valued at $50,000, the stock turnover is equal to 2. Now this is in times per year, this formula, times per year. So that means the full stock is gotten rid of and replenished twice a year. Okay, so this is like, it's equal to twice a year is a full replenishment of the stock. Of stock. Okay, if you want it in days, it's just logical. You go 365 over 2, whatever that is, 182.5. Just check on my calculator real quick. Yeah, 182.5. So once every 182.5 days, the full stock is kind of recycled. replenished. Okay, next one is debtor days. Okay, debtors owe money to you. If you're a business, you're owed money by debtors. So they are usually a current asset. Anyway, the formula is debtors over total sales revenue times 365. So let's say we have a $2 in debtors, and we have $10 of sales revenue every year. So let's do this. 2 over 10 is 0.2 times 365. 0.2 times 365. 73. 3 days. So that means it takes about 73 days for a business to collect its debts. Okay, you don't want this to be too long. Usually the lower this is, the better a business looks, because they collect their debts well, right? This is like 200 days. You know, what are you doing? People are owing money to you for so long and you're just still not collecting it. That's not that good of a thing. Okay, creditor days is the exact same formula, but you just swap out where it says debt with creditor, and that's how long it takes for a business to pay off their debts. Yeah. Okay, next one is these ratios. So gearing ratio. This is quite a common one in exams. Gearing ratio. Okay. This is equal to non-current liabilities. Not sure if I spelled that right. Over capital employed. Okay, capital employed we mentioned earlier was just the non-current liabilities plus equity. So gearing ratio is looking at how much of the capital employed did the business rely on things like long-term loans, right? Because since capital employed is equity plus this non-current liabilities, okay, is looking at how much of this is this as a percentage, right? Oh yeah, so we need that times 100. So if the gearing ratio is really high, it's not necessarily a bad thing, but it does raise a bit of a red flag of why does so much of the business's capital employed rely on long-term loans, okay? Because you do want it to be, you know, they do want some security in their own equity as well. So yeah, that's that. The next one is break-even point. This isn't really I guess it is a formula to know. This is break-even point in units. Units are on your x-axis. I'll do a dodgy sketch in a second. But it's fixed costs over selling price per unit minus variable cost per unit. Okay. You might recognize here, this whole thing is just unit contribution. Okay, this gives the break-even point in units, so you'll get a value like 40 units or something. Break-even point roughly, this isn't to scale, but you've got total revenue, you've got fixed costs, and then, gosh, this is dodgy, and then you've got total costs like this, and then that would be your break-even point. So I would do my formula, and it would get this number here, and then I know that my break-even point was there. Okay. Units are the x-axis of a break-even, by the way. The next one is kind of investment appraisal stuff. So we have ARR, which is average rate of return, which we have. The formula is in the formula booklet, but it's total returns minus capital costs over years of use. Years of use over that capital cost. So it's really just in the name, it's getting that, what is the average, how much money does this project give back per year? Okay, just to simplify this formula a bit, because they use a lot of words, basically what it's saying is total profit. All this here just equals total profit of the project. Divided by years of use and over that capital cost. And a nicer way to write capital cost, in my opinion, is just initial amount invested into the project. And usually you can see that in some kind of table, or they give it to you in a question. Initial amount invested. It's like, you know, the project costs 40 grand or something like that, and then it all just, that's what you put on that denominator there. That will get you an AIR. Final thing I think that I should note is net present value. Okay, that gives usually you have to find this in the table, which is really chill. You go year 0, year 1, year 2, I'll just go up to year 3. You get the net cash flow. Okay, because it's net present value of an investment, year 0, that is the day you make the purchase. So say it's going to ask you to do the net present value of this big new factory they've purchased, or this big new machine, okay? The net cash flow here is going to be in brackets at 0. Let's say the investment cost $40,000, okay? It's negative, that's why it's in brackets. After that, it could be making profit. Well, yeah, it would be making profit. So 35,000 made, 60,000 made in year 2. That was a good year. Then there's 42,000 made in this year. Okay, so year 0 is day of purchase. This is why we have this negative number. After that, the project is making money. Then you have discount factor. Okay, this will be given to you. This table, or the discount factors will be given to you, and you construct this table. Okay, discount factor is what the money would be worth if that money were right now, today. So obviously at the day of the purchase, $40,000 is $40,000. Okay, so that's just one. Oops, sorry. That is just one. And net present value would still be $40,000. $40,000 today is $14,000 today. There's no question about that. However, after that, the discount factor starts going down from 1. So this could be something like 0.98. This could be like 0.95. This could go 0.89. And the net present value is just this times this. So that's just how it works. So let's just do one for an example. I'll do the year 2 one. So that would be, just do that on my calculator, $60,000 times 0.95. That is 57,000. So what this is saying is that $60,000 in 2 years would actually have the buying power, would actually have the value of $57,000 today. So it helps give investors, put things into perspective of what the value of the investment is actually worth. Anyway, that is pretty much it for all the calculations that are in business and on the exam. So just memorize that.